with respect to the Bessent stuff, it's, I mean, I've been sort of looking at this a little bit, or trying to at least through just sort of like a, you know, administrative and policy kind of Occam's razor filter, which is, that, both Bessent and Trump have been pretty clear, pretty loud. We profiled this in our recent note that, you know, in their view, anything bad that happens economically in the first, 2, 3, 4 quarters of the administration, this administration, basically can be sort of blamed on the prior administration. Importantly, they have a significant trade agenda that they're looking to try to, put in place. I finished that book, No Trade is Free by Robert Lighthizer. It's a great book. If you really kind of go through the history of trade policy dynamics in this country, going back 40, 50, 60 years, you get a very good appreciation. And Lighthizer really goes down the rabbit hole of how all these different trade policies over the decades have really just hollowed out the middle class, definitely to the benefit of corporate margins and executive compensation, but have taken a tremendous toll. And I think Trump and Bessent are trying to undo a lot of, basically 40 to 50 years worth of sort of damage within, 4 to 6 months, which obviously is not going to be pain free. And I think they're being very clear about that. And at the same time, as we've also profiled, there's a silver lining here, which is that one of the biggest drivers of the deficit is interest expense. And there's a lot of debt that not only needs to be rolled in the first 9 months of 2025, close to 8 trillion, to put a number on it, but also much of it needs to be termed out because it was pulled very short under Yellen. And so that's going to be difficult and expensive. And if you happen to have a growth slowdown that happened to coincide with that period when you needed to roll a lot of that paper, especially in the second quarter, when 4.5 trillion of that paper needs to be rolled, it wouldn't be such a bad thing if you could. I mean, if you think about it, if you can, if you have to roll $7.5 trillion, if you could shave a point of interest expense off that, that would save you 75 billion in annual interest expense. Right now, you need to get the deficit down from around 1.6 to 1.7 trillion to something about half that. So you need to find like 800 billion in savings. So 75 billion isn't going to get you there, but it's an important and significant step in that direction. So that's sort of how they're thinking about it. And then I do think it's not a coincidence that the plan for these reciprocal tariffs to take effect is on April 2nd. I mean, that is basically the first day of the second quarter. Trump has kind of come out and said the only reason he didn't choose April 1st is because that's April Fool's Day. He didn't want it to come across like a joke. So I think the timing there is just a little too coincidental to think that they're not looking to really subdue activity in a meaningful way in the second quarter to help this interest expense and debt roll dynamic. So now obviously our base case for Q2 is quad 4. But you have all these other, policy overlays that basically sort of dovetail with that I think, obviously just bump up probabilistically what's pretty likely there. So yeah, that's kind of how I'm thinking about it.